We're Sheridan Capital. We're here today to talk to you about a few investment opportunities for the Highland 2 Investment Opportunity Fund. So first, we wanted to start by giving you a brief overview of the team. Sheridan Capital has put together a team of some of our most experienced real estate professionals to help and provide you with the most optimal real estate investment advice. So we want to start by going through a quick run through the agenda. We're going to provide an introduction to the two potential investment properties. We're then going to go through some trends that we're seeing in the market. We'll then provide our investment recommendation, followed by an evaluation of each one of the properties individually. So as a brief refresher on the fund, as you are all aware, this is a closed-ended fund seeking mid to short-term investment properties with 17% IRRs as well as 1.7 multiples. And these are the attributes that we looked for when we evaluated potential investment properties. So a brief overview of the two properties. We looked at St. Paul Plaza as well as the Jane Hotel. St. Paul Plaza is a Class B office complex located in the suburbs of Copper Hill. It features 3 7-story office buildings as well as a parking structure. We also looked at the Jane Hotel, which is a 120-key boutique hotel located in the central business district of Dune City. Now I'm going to turn it over to Christine, who's going to provide some insights into market trends.
Thanks, Mike. So we were asking this question a year ago, and we're asking it again today. Are we in the last inning? Are we finally in the last inning? So in terms of cap rates, we're seeing that cap rates are continuing to compress with the exception of the hotel industry. And interest rates are increasing, but they're still low as compared with historical averages. And transaction volume is down this year, but it's still solid. Looking to office investment, we see that urbanization is the main trend affecting office investment. So people are looking for that live, work, play environment. And what is that doing to investments? Well, it's looking at the pricing in the central business districts and seeing that pricing is very high there. And so investors are looking to the suburbs to find yield. In the hospitality sector, we're seeing that fundamentals are continuing to drive travel, and so there's strong RevPAR growth. RevPAR growth is particularly strong in the boutique sector, which is outpacing the broader industry. In terms of traveler trends, people are looking for unique experiences, and so they're looking more towards boutique hotels and also Airbnb, and we're going to talk about that a little bit more later. So as Mike mentioned, we underwrote 2 potential investments, St. Paul Plaza and the Jane Hotel. We are recommending not to invest in St. Paul Plaza because we found that the risks outweighed the potential upside, and only investing in the Jane Hotel. The Jane Hotel resulted in a 19.2% IRR, a 2x multiple, and uses $19.2 million in equity. I'm now going to turn it over to Josh, and he's going to walk through our analysis about why we are not recommending St. Paul Plaza.
Thanks, Christine. So St. Paul Plaza is located in Oakdale Park, an affluent suburb about 20 miles west of downtown. And since Oakdale Park is centrally located next to a number of retail and transit options, the submarket has been able to outperform the broader market. Looking at supply and demand economics in Oakdale, we feel that the submarket is well positioned for future rent growth. Currently, we're seeing that there's a limited supply of Class A office within the market, as well as minimum office development coming online over the next few years. All this is continuing to push absorption and leasing, and we're starting to see Class B office rents rise as a result. For the property, although it is a Class B office, what we like about the building is that it has a triple net lease structure, a 5-year weighted average lease term, and a stabilized rent roll. So if we invest in the project, we could immediately realize positive cash flow from day one. However, one main concern is the building's largest tenant, Southwest Equity, is set to roll in year 5. This tenant represents about 30% of the building's space, and also their lease coincides with the debt maturities that we've been offered, which we'll touch on later. As far as tenant space goes, we feel that the building is meeting some, but not all, of the live, work, play, office environment characteristics that tenants demand. However, as a Class B office asset, we feel that the limited amenities that this building has are enough to continue to demand premium rents within the market. For debt options, we chose the CMBS loan. While slightly higher priced, the loan has an 80% LTC as well as an IO structure. So if we invested in this product, what it would allow us to do is achieve attractive cash yields on the in-place cash flow. However, one concern is, again, that both debts mature in the same year as Southwest Equity's roll. As a result, this has an implication on our exit strategy, which Alex will talk about during our properties valuation. For partner terms, we thought both the contribution structure as well as the promote structure were fair as proposed. However, we would look to change the acquisition fee from 1% of purchase price to 1% of equity, as well as adjust the mandatory put option. Currently, our partner is able to cash out prior to Southwest Equities renewing their lease. As a result, this could maybe inflate their exit value. So just to ensure that they cannot exit at an inflated price, we want to be able to gain some clarity around what South Equities is doing around their renewal before they're able to execute this lease option, or excuse me, liquidity option. For exit options here, we picture either a domestic office REIT or a domestic or foreign investment firm with an office focus. Both these institutional investors have a focus on in-place steady cash flow as well as yield arbitrage opportunities, and that's why we think they'll be a perfect buyer for this. So Alex is now going to walk you through the property's valuation.
Thanks, Josh. So I'm going to start by walking you through our base case model and then walk you through two sensitivities that we ran that ultimately led us to pass on the deal at this time. So our base case looks at a 6-year investment horizon, and what got us there was Southwest Equities rolls in the end of our 5th year. We assumed a 50% renewal probability, restabilized at a 90% stabilized occupancy, and then we sold at that point. One important assumption I want to mention is we do have to refinance the debt because it does mature in our hold period, and we assumed a 9.5% debt yield on the refinancing. We exited at a 7.5% cap rate, and that led to a 17.4% levered return and a 1.9 times multiple. Although that is within our fund's metrics, we did run a few sensitivities around this to see what the returns looked like and how sensitive they were to Southwest Equities renewing. The first sensitivity we looked at assumes that if they were to leave and we got that 160,000 foot block back, it would take us the course of 2 years to restabilize at a 90% occupancy. This extends our hold period by 1 additional year, but what's really impacting the returns here is to keep that 9.5% debt yield. We require an additional $20 million equity paydown, which is significantly impacting the returns and reducing them to a 15.8%. One additional scenario we looked at is, as we mentioned, a lot of tenants are looking for this suburban, urban type of community with that live, work, play atmosphere, which this property does not fully accommodate today. So in order to get that net absorption that we might need, we considered investing an additional $20 million of capital. This would go into building systems, lobbies, landscaping to create that type of community, and the returns would further drop in this scenario to a 13.1%. Given this drop in returns and how sensitive the returns are to Southwest Equities and this debt maturing at the same time, and the significant amount of capital we might need to invest in order to pay down that debt, we are not recommending pursuing the deal at this time. There are a few additional next steps that we considered looking at because we are bullish on the Oakdale market generally. One thing would be looking at debt quotes on a 7-year term and what type of structure the capital markets might put into the Southwest Equities rollover. If we could potentially fix our downside, it might be a reason to do this deal. 2 other scenarios. One is regarding restructuring Southwest Equities lease. If they're committed to this building for the long term, we might be able to give them some TI capital or rent concession today in exchange for an early renewal and maybe realize some upside right away. Similar to that is a potential buyout of their lease early. So if they're thinking that they want to move to the CBD and we think that they're a very unlikely candidate to stay, we might be able to negotiate some sort of discounted payoff off of their remaining lease obligation, get that space back early, and reposition to Class A. One other thing we did want to note is the FAR potential on this site. We did not feel comfortable attributing any value to this because rents do not support building today, but we would look into this further. I'm now going to pass over to Mike, who's going to introduce the hotel opportunity to you.
Thanks, Alex. All right, so I'm going to talk to you about the Jane Hotel. And we think that in order to understand the investment, it's first good to look into the market of Dune City, specifically in the CBD. So the Jane Hotel is located within Dune City CBD, which is home to multiple Fortune 500 companies, as well as regional offices for multiple banks and investment firms, which makes it a concentrated area for business travelers. Additionally, the Jane Hotel is located in close proximity to 2 large convention centers, which bring an additional 615,000 room nights to Dune City each year. What excites us the most about this market is that it's currently experiencing RevPAR growth far above national averages, and there are currently only 2 additional hotels in the pipeline to be built nearby. So now regarding the property itself, built in 1898, the Jane Hotel operated as an office building until 2006, at which point it underwent an $80 million interior renovation to build out a bar, mezzanine area, and 120 luxury hotel rooms. Now, while it provides some of the best amenities within Dune City, we feel it is currently not being operated at the level that it is capable of, which is why it's currently operating at 95% of occupancy penetration and only 90.5% RevPAR penetration. We see this as a high potential return investment, and that's why we have a four-pronged strategy to reposition this hotel as the hip go-to location for the business traveler, convention goer, or Dune City resident alike. Our four-pronged strategy involves refreshing the F&B, improving operations, seeking a membership with a soft brand and rebranding the hotel, and finally turning the underutilized mezzanine space into the flexible office space of the future. I'm now going to turn this over to Colin, who's going to provide some details.
Thanks, Mike. So the first part of our strategy is really figuring out how the hotel can better meet the needs of travelers and workers alike. We see that today, hotels are not just a place for the weary traveler to lay her head at night, but really a place for travelers and locals alike to live, work, and play throughout the day. And so we want to craft a food and beverage offering that really combines that coffee shop, cocktail bar ambiance in an inciting and inspiring atmosphere all day long. To this point, we're seeing that smaller luxury boutique properties in historic buildings are doing this all across the Central Business District, and they're the ones at the forefront of reimagining downtown hospitality. Two great examples are the Ace Hotel in New York and the Chicago Athletic Association, which in such an innovative way have really blurred the lines between lobby, bar, restaurant, and meeting space. The second part of our strategy is improving the operational efficiency of the hotel, and to do so, we're going to partner with Gemini Hotels, which are experts at repositioning undervalued assets, and they have experience right here in Dune City. We'll of course give them a base management fee of 3% of revenue, but we're also going to provide an incentive fee structure that's tied to RevPAR penetration. This will allow Gemini to perform at the hotel, not just in a vacuum, but really tied to our comp set, to what the competition is doing as well. And we were also going to add a termination right so that if Gemini does not perform at 90% of RevPAR penetration, and if they do not cure up to that 90%, we can cancel that agreement. The third part is really looking carefully at soft branding. So soft branding provides two solutions today. One, they provide the smaller independent hotels access to distribution benefits. And two, they provide loyalty-driven business travelers looking for that unique experience, the ability to earn and redeem rewards. There are a couple of disadvantages of soft branding, namely the associated fees that work in a franchise-like model, but we see, especially with this asset, numerous advantages that outweigh those cons. Primarily access to marketing and a larger consumer base, less reliance on online travel agencies, as well as the ability to still maintain your freedom. The third, or to this end, we propose partnering with the Autograph Collection by Marriott. So in addition to an attractive fee structure versus the other soft brands, what we really like is that Marriott has the largest member base that focuses specifically on business travelers. And this is in part due to their recent acquisition of Starwood Hotels with the gold standard SPG program. And so we think this is a great fit. Additionally, Autograph's value proposition focusing on locally driven and beautifully orchestrated experiences that focus on the hip business traveler through their boutique business travel initiatives really aligns with what we're trying to do with this property. And the fourth part of my apologies, the most exciting part is that in addition to the soft branding, we're actually going to rebrand the Jane. So out with the old, in with the new, welcome to the Exchange. We feel like this name and this brand refresh really capture all the positive attributes that we want to showcase at this property. A historic building, a financial district location, the collaboration and exchange of ideas, as well as a hip business offering. And to our last point, the last strategic pillar, we're going to partner and leverage the Marriott relationship to use Marriott's Meetings Imagine platform to offer flexible, collaborative, and state-of-the-art meeting space on the underutilized mezzanine level. And this will provide untapped revenue of $500,000 per year. So at this point, I'm actually going to hand it over to Adam, who's going to walk you through the property financials.
Thanks, Colin. So while underwriting this building,
we decided to utilize the debt fund financing for a couple of reasons. First of all, it has a higher proceed. Next, it's got the IO structure, the non-recourse, and lastly, the term fits with our proposed hold period of 4 years. So as for the partner terms, we think the proposed terms don't necessarily compensate the members for the inherent risk in hotel investments. So we decided we'd like to negotiate that baseline hurdle up to 12%, and then within the second bucket, split equity 80-20. And then as for the exit options, we think there's a lot of potential investors who'd be interested in this boutique hotel, and that includes hotel REITs, domestic and foreign institutional investors. And the reason we think that they're going to be interested in the boutique hotel is because of the premium room rents, the iconic status, and the fit with their appetite for this risk-return profile. So now we'll get into the meat of the analysis. We kept the ADR, occupancy, and RevPAR given to us by the deal team, and we think that we can support this through our four-pronged strategic initiatives. And so as part of that, we included the income of about $50 a square foot starting in 2018. And to make sure that we make this a state-of-the-art facility, we've added an extra $500,000 in CapEx. And then overall, just to make sure we can maintain the hotel, we included a 2% capital reserve. And lastly, we decided to use a 5 3/4 exit cap rate, which is above the current going-in cap. So that brings us all down to the bottom left, where you can see that drives returns of 19.2% IRR with a 2 times equity multiple. And so we're excited that these are over the hurdle rates for the fund. We're also very excited about how comfortable we are with this. And that comfort comes through the current very discounted RevPAR to our competitive set. And so with any investment, we obviously have some risks. Our key 3 risks that we see are the repositioning, the hotel industry in general, and Airbnb. So for the repositioning, obviously the question is, are customers going to want this building, want this asset? And so we think that, as we've kind of touched on, we're hitting the sweet spot for that live, work, play business traveler. Next, with the hotel industry, obviously it's more volatile than a lot of the other asset classes. Right now, RevPAR growth is slowing, and you have rising cap rates. But looking at boutique hotels in general and this local market, the RevPAR growth is well above the national average, and there's very limited supply coming online. Lastly, with Airbnb, this is obviously coming in and disrupting the space. It's coming in, adding supply all over the place, but we see they are really targeting a very different demographic than we are. We're going for the business traveler who's not actually going to be staying at Airbnbs. And so we're very excited to recommend the exchange for Highland 2 due to the new revenue sources, the expanded customer base, the improved operational efficiencies, and the current discount to replacement costs. We think this is a great way to get the risk-adjusted returns for Highland 2.
All right, thanks, Adam. So we wanted to provide a quick summary conclusion for anyone who's looking at their phone right now to try and book themselves a room at the exchange. We are very excited about the potential for investment in the exchange, and that's why we recommend investing in the exchange. It provides high returns in a high-demand market. We do not currently suggest investing in St. Paul Plaza. However, we suggest keeping an eye on the Oakdale market, as we do see this as an area that could provide returns in the future. Thank you guys very much for coming out, and please let us know if you have any questions.
Yeah, you mentioned hotel revenue growth and RevPAR is slowing down, but yet, I guess in your analysis, you assumed RevPAR was going to go from 228 currently to 340 over a 5-year period, and I guess just a little bit on how you got comfortable with that, or if you looked at sensitivities, if the results were different than that.
Sure. Excellent question. So first, there's a couple things that we wanted to mention. I think they might have been touched upon. So while RevPAR growth might be slowing on a national level, there are 2 things that really make us comfortable with what we're seeing. First, at a national level, boutique properties and the RevPAR associated with those types of hotels are growing faster than the national average. So that's something that we are comfortable with. Another aspect that we are comfortable with is the Dune City market itself, with RevPAR growth that is far outpacing the national average. So we see really strong fundamentals in the Dune City Central Business District. And the additional thing that we want to highlight as well is through the repositioning of the hotel, we're focusing less on getting travelers through the online travel agencies, which today makes up 50% of bookings. We're looking to reduce that substantially and leverage Marriott's member base and the higher paying business traveler that we're going to be targeting. So we expect significant growth in that type of consumer.
We also ran some sensitivities around if we hit a maximum occupancy, and even if our maximum occupancy through that 5 years is 81%, we're still above the 17% IRR, so that gave us a lot of comfort in those numbers.
In your structure with your partner, you guys are also multiple and IRR driven in your fund. Did you consider altering the structure at all to be also include some multiple hurdles with the operator?
For the hotel specifically?
Yes, for the hotel.
Okay. In this case, we did not look at that. This was an operator, or our GP partner, one is someone that we have worked with before, and so we thought that hurdle structure was appropriate. And in terms of also bringing in Gemini as the actual operator, we thought that having just the regular operation or management contract was sufficient. And also it protects on the downside, given that we have tied their incentive fee to RevPAR penetration and have also added that termination right if they fall below 90% of RevPAR penetration and do not cure back up to that level.
Anything else? Anyone else?
So you're, St. Paul, it hits your target underwriting. You've got 7 months left. $150 million left. That makes 7 months and you pay 80. And this investment hits your target. How hard was it to turn that down?
So we were very concerned about the downside of this deal, and we did not feel comfortable putting out capital just because we're nearing the end of our fund life. That's not our duty to A, our investors, and B, our reputation is everything. So if we're going to go out, raise money in the future, we're going to look for deals that we feel comfortable on a risk-adjusted return basis, and this deal didn't hit that metric for us.
Staying on that same theme, it sounded like, but for the lease structure and the debt structure of an office building, you would have liked that opportunity and you liked that submarket. Maybe speak a little bit to why you like that submarket, and maybe speak to why you like the thesis surrounding suburban office as a whole.
Yeah, sure. So I can take this. So right now we're seeing a lot of corporate relocation from the suburbs to the CBD. But really, we see that for a limited type of client. A lot of financial services clients are making that move to go after younger talent and maybe a larger labor pool. And also talent that wants, this millennial talent that wants really this live, work, play environment. However, within the suburbs, we still see a lot of industries staying out there who need more space. So pharmaceutical companies, biotech, we're still seeing those type of tenants staying out there who need more space for their type of industries. So I think we're still very comfortable that those industries will continue to be out in the suburbs. They have access to executive housing. They still have a number of amenities around them, from shopping centers to retail to transit. Also, they're in close proximity to the CBD, only 20 miles. So all of that puts a lot of comfort that although this train is moving from the suburb to CBD, we still think the suburb is going to be around, and we think it is even going to come back as millennials start a little later on, but coming back and moving to the suburbs.
And I would also add that there's going to be a tenant base that's looking for that discount, that lower rent, and you can find that in the suburbs and you can't find that in the CBD.
So knowing that the hotel industry is very cyclical, as you looked at your overall underwriting, where did you feel like you were leaning into your assumptions to generate your return?
So I can take that. So obviously that RevPAR penetration is kind of where we were using our basis. That competitive set is not all boutique hotels. It's kind of all over the place. And boutique hotels tend to demand that higher room rate. So we felt comfortable that even getting to just the baseline of RevPAR of our competitive set, we're still just under the fund metrics at around 16% and a 1.8 multiple. So we still felt there's a lot of comfort if even on the very downside where we only get to baseline, we're still pretty high up there And I think we were pretty conservative with our income from the meeting space. And so we think there's definitely some space there to grow that, to kind of help offset the hotel revenue.
And the one other thing that we want to point out is that, when you look at all the types of assets out there, this particular property is really the definition of an irreplaceable asset. It's a 19th century building in a built up, dense urban market. And so there's not that many properties out there that are similar to what we have. And so we are also confident in the longevity of our type of iconic asset and what we can charge and what we could potentially sell it at.
Very, very good.
Thank you so
Great
much.
job.